Okay, we're back with Random Roger's Big Picture. This will be the big picture for the week of September, what are we, September 17th, I guess. We'll try and do a little better this time, maybe a little less flopping and twitching, hopefully a few less ums and ahs, but we'll see. Let's just see what happens. Let's talk about the market first. The S&P 500 had kind of an interesting day. It was not able to get above the old high from May at 1325. The high print was 1324 and change. That's something to keep in mind. A lot of people, and I was saying this all summer, were very leery of the rally, saying we were going to make a lower high. Not sure if this really qualifies as being a true lower high. I think it's about equal, but I think come Monday or Tuesday it'll be important to see whether or not it can punch through. I've been negative for a while, and so obviously you probably know where I stand. I am skeptical, catching some of the rally to be sure, but I wish I was catching more. That's just how it goes. Next, I wanted to try to catch up on some questions. We got a lot of emails or a lot of comments left on the blog, and it's tough to always keep up, but maybe this is a good chance to try to do that. We've got one question here. Since Canada and Australia's markets are thought to be proxies for commodities, do I think the recent commodity pullback will impact their currencies and their markets in general? Short answer is yeah. On a day-to-day basis, they do move those markets. The fact is the Aussie is down a couple of cents. It was printing in the low 77s for a while. Right now I've got it at 75.33. It's been lower than that this week. The loonie has had a similar movement, and it makes sense that which is bad for commodities and oil is going to be bad for these two countries, for the markets and the currencies. This is important to realize, and why, as much as I preach having exposure, I don't pound the table and having 20% in each place. Far from it. Something to keep in mind, kind of in all things in moderation. That's pretty important to what I do. If you've been reading the site for a while, you probably know that. Let's click on to the next question here. This next one, with the apparent decline in oil prices, at least for a while, it would appear that transports could do well over the short term. Any comments? Also, I was curious why the airlines do not have large representation in the transports. Thanks. Well, you're probably lucky that the airlines don't have a big representation in the trannies. The fact is, though, that they've done well. That chart that I put on the blog on Friday morning showed them topping out at 5,000 twice, once in May, once in July, and then a bottom print around 4,000. It's up around 4,400. That is pretty good. That's a 10% lift coming off of the bottom, and that's happened as energy prices have declined. To me, it seems that if this really is just the normal seasonal shoulder season type of oil trade, be curious to see what happens to energy. What happens to the transportations, airlines included. I've only got one transportation stock for clients. I've got Volvo, and it's been immune somehow, I think it's more luck than anything else, to the sell-off that happened earlier in the summer, and it's kind of participated with the lift higher. The fact that it didn't participate in the sell-off makes me think it's just in its own world right now and not really correlated to what's going on, and that makes sense. They're a foreign company. Good things happening in Sweden. They are a Swedish company. My 2 cents. Let's see what's next here. That was one just agreeing with me on my thoughts about the Fed not raising rates. So I'll move on from that one. And okay, someone leaving a question about the options market systematically biased downward due to a plethora of covered call strategies being used to generate income. I think extraordinarily low implied volatility supports the idea. I agree. And that's something I touched on before, not something I thought of by any means, but there is something to it. Too much supply, or maybe not too much, but a lot of new supply of something does move markets. There certainly is a complacency in the market as well. I think that's manifested by the narrowness of the equities trading range. If you think about how long it's been since we've had a 10% correction, although it's been a nice move up off the bottom, it's been far from heroic. In the last few years there have been, think about 97, 98, 2002, 2003, some massive moves up, fast and hard. And we're just not seeing that. The market is just kind of drifting higher. It's probably a little healthier. We'll see. We'll see what that means. Tough to call right here, right now. Let's move on to the next one. Okay, someone asking about putting ETFs in a tax-advantaged account. Okay, well, that's a tough call to make. Kramer, stop. that is a tough call to make as far as, oh, well, I've got an IRA, all my money is there, so I should just use ETFs. Not a fan of all ETFs, regardless of the account, regardless of the tax situation. There's a lot that's given up, and that's important to realize that they have their drawbacks. And you see a lot of articles or other websites or what have you that pound the table about how great ETFs are. They're not. They're a tool. That's plenty of utility, to be sure. I use them a fair bit in my practice, but you're gonna miss things that would be easily captured, easy themes, by just using ETFs, not using individual stocks or the occasional open-ended fund or some other product. So I would urge you to broaden your horizons just a little bit. And let's see if there's anything else. Something from my Street.com editor. Here we go. This is what I wanted to get to. Someone who says he's new to investing, Tom K. However, based on the question, I don't think he's that new to investing. Sorry to call you out on that, Tom K., but here we go. He asks what I mean by commodities. For example, the CRB index is a commodity weightings. The question is misworded there. So what do I mean by commodities? Well, I think there's a couple of different ways to access it. The purer you go, whether it's the DBV ETF, the GLD, SLV, USO, I must be missing one or two of them, right? If you go with one of those, that's a pure play. The further you move away, the more of a derivative effect you're going to get. If you buy a mining stock, if you buy an energy stock, you capture most of the effect, but it is a little muted. If you just buy something from Australia, you're buying, like a bank or something, you're buying a stock that benefits from a booming economy, but the correlation still could be fairly low, or lower than you would think anyway, to commodities. So it depends on what you're really trying to capture, is how I would answer the question, what do you mean by commodities? It can mean anything. I've always read that commodities are a poor investment vehicle over the long term. I just looked at some long-term charts, commodity index, they seem to bear this out. Okay, fair enough. Stocks are the best way to go over longer periods of time. I've never said otherwise, and I preach the same thing over and over. The reason why I have commodity exposure is to zig when equities zag. It's that simple. It's that important to me, and this has helped a couple of times over the last few years. I imagine it'll help a couple of times again. But if at any point my commodity weighting is leading the way higher, chances are most other parts of the stock market are not doing so well, and so I'm not rooting for gold to go to 1,000 or 2,000 as the way some people seem to be. Far from it. When gold leads, I expect bad things to come. It's all about diversification. You've got to have some things always going up, some things always going down. Hopefully you blend it in such a way where you have more up than down more often than not. That simple. One last thing, just because some commodities run counter to stocks or bonds, reducing overall volatility, does it really make sense to include commodities? I mean, you could reduce beta by including an inverse stock fund. Yes, you could. And there's nothing wrong with doing that. I do a little bit of that. It's whatever is right for you. It's a pretty simple thing if you care about this sort of diversification in the first place. And clearly, if you watch the Idiot Box, there are plenty of people that don't care. So temper that as you move forward. Plenty of people don't care about a counter strategy, about having something that goes up when it hits the fan for stocks. I want to have that protection, quite frankly. I want it. My clients, I believe, want it. At least that's the feedback I get. If we have a crash, they'd like to be a little better than capturing the crash point for point. But there you have it. All right, I think that's going to wrap it up for this time. This is going to take forever to upload. Thanks for stopping by. Hopefully this is a little better. More importantly, hopefully the next one is better still. For now, I'm just going to plan on doing these once a week, and that's it. Have a good weekend.